Andrew, thank you for joining us. How did the Harmony portfolios fare in November?
Thanks, Richard. The Harmony funds had another good month in November with gains of 0.2 to 3.2% across the funds. Equity and fixed income asset classes contributed to returns pretty much across the board. And particular highlights included the outperformance of our global equity managers and good absolute returns. Good performance from convertible bonds, outperforming equities on a global basis, and also our Japanese equity holdings.
A note on that divergence, the 0.2 or 0.3 going through to the 3.2%. What drove that?
So developed markets were up about 2% in dollar terms for the month. Emerging markets on a regional basis were flat to down. So that hampered the returns of the Asian balance and Asian growth portfolios. The US dollar was strong. That's bad for emerging markets typically. Commodities were weak as well, and that held back the Australian market in particular. So there were more subdued returns from the Australian dollar growth portfolio. On the other side of things, UK assets performed well, including equities and bonds, and our UK equity managers performed particularly well. So the GBP portfolios were towards the top end of the range there. And then also our Euro balance portfolio performed reasonably well, gaining around 2% or so. Worth noting there that portfolio is transitioning to a Euro diversified risk profile, slightly higher strategic asset allocation in equities there. We think that will help the portfolio achieve its long-term objective of capital growth, particularly at this time when fixed income yields in Europe are hitting multi-century lows.
Absolutely. When you mentioned commodities, I assume we're talking about this big and obvious fall in the oil price.
Yeah, exactly. The oil price was down around 18% in November, so a huge fall and very rapid as well. That has big implications for the whole market and all asset classes, but clearly most specifically to energy-related stocks and those countries with a very high dependence on oil revenues. Our portfolios have fairly limited direct exposure to those areas that really struggled during the month as a result of that. Although having said that, emerging markets equities took quite a hit. Russia is a large component of the benchmark there, and Russia was significantly affected. And also our global deep value manager, Copernic, struggled as a result due to their sector allocations at the moment.
Looking at managers there, it's been quite a tough year actually for active managers. How did the managers using the portfolios do in November?
Our managers actually had a pretty good month in November,
okay.
But you're right in pointing out that it's been a difficult year for active managers in general, on average, across global and most regional areas. There have been a number of factors driving that. Most particularly, small caps have been underperforming large caps. Most managers have something of a mid or small cap bias to some extent. The US market has been very strong, far ahead of other markets, and it's been a relatively narrow market as well. It's a smallish number of sectors and stocks have been driving the market higher, whilst others have lacked more than it may seem at the headline level. But it's somewhat a cyclical thing, and we still remain very confident in underlying managers, and over the medium to long term we expect them to deliver good outperformance.
Andrew, thank you very much.
Thank you.